The third quarter of 2025 was a decent one for markets overall, with global equities and bonds advancing. In part, that was driven by ongoing resilience on the growth side, as the tariff impact wasn't as negative as many had feared at the end of the second quarter. Meanwhile, the Fed's move to cut rates in September offered further support, particularly for US bonds, which in turn then pushed gold prices higher. However, it wasn't all good news, and fiscal fears in Europe put long-dated bonds under pressure there, particularly in France. US tariffs remained one of the biggest themes over the third quarter. In the start of July, we still faced the original 90-day tariff extension deadline that was announced shortly after Liberation Day in April, which was scheduled for July 9th. But the tariff implementation was then delayed to August, and President Trump sent letters to various countries announcing what tariff rates they would face. Towards the end of July, the US reached trade deals with a variety of economies, including the EU and Japan, and both faced new tariffs of about 15%. So that represented an increase from the original 10% baseline, but wasn't quite as high as many had originally feared. And that was certainly beneath the original levels proposed back on Liberation Day in April. Nevertheless, tariffs remained a key theme for investors, aside from the announced trade deals, with higher rates on Canada and Mexico, as well as new sectoral tariffs. Otherwise, another key theme in the third quarter was growing signs of weakness in the US labor market. That pushed the Fed towards a September rate cut. Essentially, that's because the US July jobs report was quite a bit weaker than expected and included substantial downward revisions for May and June. The August jobs report was also underwhelming. So its unemployment rate showed the highest since 2021 at about 4.3%. All of that led US Federal Reserve to pivot in a more dovish direction, delivering their first rate cut of 2025 in September. They also pointed to further 50 basis points of rate cuts by the end of this year. The prospect of more stability on tariffs and rate cuts from the Fed generally led to a strong backdrop for markets. So the S&P 500 advanced just over 8% in total return terms through the quarter. Other indices like the Euro Stock 600 and Japan's Nikkei were also up quite nicely. That was generally echoed for bonds too, with Bloomberg's Global Bond Index up just more than 0.5% in the quarter. One exception to the generally positive performance came from long-end bond yields in Europe, where concerns about the fiscal situation continued to mount. France was really at the center of this, as Prime Minister Bayrou lost a confidence vote and they faced a credit downgrade from Fitch. Despite fresh attacks on the US Federal Reserve's independence, US bonds were essentially flat over the quarter. Gold prices hit a record high of just shy of $3,900 an ounce in the third quarter, as rate cuts helped to increase demand for the precious metal. The move left that metal up 17% in the third quarter and 12% in September, marking its strongest monthly performance since all the way back in August 2011. At that point, you had the US debt ceiling crisis and the Euro sovereign debt crisis was escalating. This year to September, gold rose nearly 50%, which leaves it on track for its strongest annual performance since 1979. That year saw prices surge more than 127% against the backdrop of the oil crisis post the Iranian Revolution. In turn, that drove a fresh surge in inflation and led investors to seek out gold as a hedge. Within equities, from a style perspective, there was less divergence than usual, although growth did outperform in the quarter. What was interesting, though, is when we look at sectors, the clear winner was mining, up about 25%, while tech globally only delivered about 12%. Defensive stocks like consumer staples, which were down 2%, and healthcare, which was only up 3%, those lagged the market. When looking at South Africa, the rand strengthened by another 3% over the quarter to be up 8% versus the dollar so far in 2025. South African stocks had another very good quarter, rising about 13% in rand terms and 16% in dollars. This means that our local market was up 32% in rand and 44% in dollars so far in 2025. Gold and platinum miners really do remain the key story of 2025, with most of these up more than 50% in the quarter and more than doubling year to date. Anglo Gold, which we've held for some years now, was up 51% in the quarter and 164% so far this year. Northam, which is another stalwart in our portfolios, delivered 47% in the third quarter and 158% so far this year. As typically happens in our local market, when resource prices spike, is that miners do become an inappropriately large proportion of the JSE All Share Index. Precious metal miners now make up more than a quarter of our local market. In our opinion, it's not appropriate to hold such a large proportion of an equity portfolio in such volatile industries. Given the high precious metal prices currently, our portfolios now reflect a more measured approach to our precious metal exposure. The rest of our market actually looked quite pedestrian by contrast. Financials were up only 1%, industrials up about 4% in the quarter. If we then switch gears to performance, our worldwide equity portfolio's performance over the third quarter was a healthy 8% in rands. Over the last 5 years, this portfolio has returned more than 14% per year after fees, which is more than 9% a year above inflation. Despite that excellent outcome for clients, this portfolio did lag its benchmark somewhat in the third quarter as we held less gold than the benchmark. The worldwide equity portfolio is in the top 20% of its peer group over the last decade. The story was similar with our South African equity portfolio. That delivered 11% over the quarter to be up 24% so far this year. Again, despite excellent nominal performance, we did lag our benchmark thanks to holding a little bit less gold. Relative to peers, the South African equity portfolio is in the top half of its peer group year to date and over 1 year, and this portfolio remains in the top quartile of its peer group over 10 years. It has delivered 18% a year over the last 5 years, which is 13% per year ahead of inflation. Moving across to our multi-asset Regulation 28 portfolios, the short-term performance was encouraging. The balanced, moderate, and conservative balanced portfolios were all about 1% ahead of their peer benchmarks in the third quarter, despite taking less risk than their peers. All three of these portfolios are ahead of their benchmark over 10 years. Over the last 5 years, they've delivered 6 to 8% per year ahead of inflation, which is in line with their risk tolerance. Looking back at the activity within the portfolios over the third quarter, we continued to see quite a few interesting opportunities. In July, we added to Valterra Platinum, the old Amplats, diversifying our platinum miner exposure beyond Northam, which we still though see as the best player in the platinum sector on a through-the-cycle basis. In August, we bought Shoprite, a business we've held before and where we've long liked the quality. From the time we sold it 3 years ago, when we viewed the valuation as just too demanding, until we recently added again, it underperformed the South African market by about 40%, certainly vindicating our 2022 exit. In August this year though, the price was right, and we took the opportunity to add to the business, which we certainly see as a long-term compounder. Late in the quarter, we reduced our Anglo-American holding after the company announced a merger with Teck Resources. Effectively here, the market rapidly priced in all of the expected synergies from the deal, but we see some execution and timing risk around the deal, so we took the opportunity to bank some profits. In our global direct equity portfolios, we took some profits on Hilton in July and recycled that cash to a combination of the high-growth Nubank in Latin America and defensive compounder Berkshire Hathaway. In August, we switched out of pharmaceutical giant Roche and added to animal health leader Zoetis, where we see far less regulatory risk than in human pharma. We also added leading global insurance broker Aon. Overall, our positioning across our portfolios at the end of September was marginally overweight equities at an asset class level, although slightly conservative in terms of stock selection. Within equities, we're overweight South Africa and underweight global stocks, which are now looking quite expensive. We're also overweight South African bonds and underweight cash in those multi-asset portfolios. Last quarter, we expressed growing optimism about the South African economic outlook from the current low base. We maintain that view and are even maybe a little bit more positive than previously. The virtuous economic cycle that we're looking for has been strengthened by both higher precious metal prices and a lower oil price. With South Africa's economy set to benefit from these high gold and platinum prices, it certainly helps the rand via trade flows. That then helps inflation. We also have a positive impulse for government finances, which should help bring bond yields down further. They've already come down quite a bit so far this year. That in turn helps government finances more, and that combined should help to hold the GNU together. If the current precious metal prices hold, we expect the overall South African economy improve, soon enough helping domestic-focused businesses like banks and retailers, which we expect to see do quite well over the next 12 months. Globally, despite signs of softness in the US labor markets, which is a lagging indicator, we expect the strong productivity gains and rising corporate profits to reduce the risk of any sort of economic downturn there. We expect the Fed's renewed easing cycle on rates to extend the economic expansion and to continue to support risk assets for now. Cyclical stocks should perform quite well in this environment, although we note that the ongoing optimism could eventually drive some sort of AI-related equities bubble in the future, although we're not there yet. We see some attractive opportunities in so-called South Africa Inc. stocks on the local market on both an absolute basis and relative to global opportunities. Within our portfolios, we maintain a healthy balance between quality, valuation, and cyclical opportunities. However, the defensive and quality bias of the portfolio does result in a slightly lower beta portfolio versus our benchmark, so our performance may lag slightly if we get very sharp market rallies, but we'll certainly expect much better downside protection during any kind of declining markets.